For years, the story of the 1920s stock market boom has been told in a very simple way. It's usually described as a decade of excitement, rising markets, and easy money that suddenly ended with the famous crash of 1929. But that version of history skips over something important. The boom of the 1920s didn't appear out of nowhere, and it wasn't just the result of reckless investors chasing quick profits. It was the product of technology, optimism, political decisions, and a financial system that quietly encouraged speculation. To really understand the crash that shocked the world, you first have to understand the environment that made the boom possible. The United States entered the 1920s in a unique position. Europe had been devastated by World War I. Factories were destroyed, governments were drowning in debt, and entire economies were struggling to recover. Meanwhile, the American industrial machine had grown stronger during the war. U.S. factories had supplied weapons, vehicles, and equipment to the Allied powers, and by the time the war ended, American production capacity was enormous. The country suddenly became the center of global finance and manufacturing. For many Americans, it felt like a new era had begun, one where prosperity might last indefinitely. Technology played a major role in creating that sense of endless progress. The 1920s saw the rapid spread of automobiles, radios, telephones, and electric appliances. Companies were producing goods faster than ever before, and consumers were eager to buy them. Factories used new assembly line techniques to increase efficiency, which lowered costs and boosted profits. Businesses expanded rapidly, and investors noticed. If companies were producing more goods and owning more money, then their stock prices should rise as well. That logic seemed simple and convincing, and millions of Americans began paying attention to the stock market in a way they never had before. Another powerful force behind the boom was the expansion of credit. During the 1920s, borrowing money became much easier than it had been in earlier decades. Banks and brokers allowed investors to buy stocks on margin, which meant they could purchase shares using borrowed money. In many cases, an investor only needed to pay about 10% of the stock's price upfront. The rest was financed through loans. If the stock price went up, the investor could sell the shares, repay the loan, and keep the profit. It sounded like a perfect system, and as long as prices continued rising, it appeared to work beautifully. This system created a powerful feedback loop. As more people borrowed money to buy stocks, demand increased. Higher demand pushed prices upward. Rising prices attracted even more investors, many of whom had little experience in finance. The stock market slowly transformed from a place where businesses raised capital into a national obsession. Newspapers reported daily price movements. Radio broadcasts discussed market trends. Ordinary people who had never owned a share before suddenly believed the market was the fastest path to wealth. Speculation became a defining feature of the decade. Instead of investing based on a company's real performance, many buyers simply purchased stocks because prices were rising. The assumption was that someone else would always be willing to buy later at an even higher price. This mindset created a culture where risk was often ignored. Investors weren't asking whether a company was truly worth its market price. They were asking how quickly they could turn a profit. In many ways, the stock market began behaving less like a reflection of economic value and more like a giant betting arena. Corporate behavior also fueled the boom. Many companies wanted their stock prices to rise because high valuations made them look successful and powerful. Some firms used creative accounting methods to make profits appear larger than they really were. Others issued new shares to take advantage of the excitement in the market. Investment trusts, early versions of modern mutual funds, also became popular. These organizations pooled money from investors and used it to buy large amounts of stock. While they promised diversification, many trusts were heavily leveraged, meaning they relied on borrowed funds just like individual investors did. Government policy played a quieter but important role as well. During much of the 1920s, regulations on financial markets were relatively weak. The belief at the time was that markets worked best with minimal interference. As long as the economy appeared strong, few officials saw a reason to question the rapid growth of stock prices. Interest rates remained relatively low for much of the decade, which made borrowing even easier. The financial system was essentially providing fuel to a speculative fire that few people believed could burn out. At the same time, the real economy was more fragile than it appeared. While cities were booming and industries like automobiles were expanding, other parts of the country were struggling. Farmers, for example, had expanded production during World War I to meet global demand. After the war ended, demand dropped sharply, but farmers were left with high debts and falling crop prices. Rural America entered recession years before the stock market crash. Yet these warning signs were largely ignored because the financial markets were telling a much more optimistic story. Another hidden weakness was the uneven distribution of wealth. Much of the economic growth of the 1920s was concentrated among businesses and wealthy investors. While many Americans enjoyed rising living standards, a significant portion of the population did not experience the same level of prosperity. Consumer spending was increasingly supported by credit rather than income growth. People were buying cars, appliances, and household goods with borrowed money. This created the appearance of strong demand, but it also meant the economy depended heavily on continuous borrowing. By the late 1920s, the stock market had reached extraordinary heights. Prices climbed rapidly during 1928 and the first half of 1929. Investors believed they were witnessing a permanent transformation of the economy. Economists and financial leaders often spoke confidently about a new era where modern industry and technology had eliminated the old cycles of boom and bust. When markets rise for long enough, confidence slowly turns into certainty, and by 1929 that certainty was everywhere. But beneath the surface, the system was becoming dangerously unstable. Because so many investors had purchased stocks with borrowed money, even a small drop in prices could create serious problems. If the value of a stock fell below a certain level, brokers would issue what was known as a margin call. Investors would be forced to either deposit more money or sell their shares immediately. If large numbers of people tried to sell at the same time, prices could fall very quickly. The structure of the market meant that the same leverage that fueled the boom could also accelerate a collapse. In the months leading up to the crash, a few observers began expressing concern. Some economists warned that stock prices had become disconnected from the real economy. Others worried about the enormous amount of margin debt circulating through the financial system. But these warnings struggled to compete with the excitement of rising markets. When people see neighbors getting rich, caution often disappears. The belief that prosperity would continue indefinitely was simply too attractive to abandon. The truth about the 1920s boom is that it wasn't just a story of greed or speculation. It was the result of a powerful combination of innovation, optimism, and financial experimentation. Technology was transforming daily life. Industry was expanding. Credit systems were evolving rapidly. All of these forces created genuine economic growth. But they also created an environment where expectations became unrealistic and risks were underestimated. When the market finally began to fall in late 1929, the fragile structure of the boom quickly revealed itself. Falling prices triggered margin calls. Margin calls forced investors to sell. Selling pushed prices even lower. What had once been a powerful upward spiral suddenly reversed direction. Within weeks, fortunes that had taken years to build disappeared. The boom that had symbolized modern prosperity turned into one of the most dramatic financial collapses in history. Yet the most important lesson from the 1920s boom isn't just about the crash that followed. It's about how easily financial systems can create the illusion of unstoppable progress. Rising markets can convince people that the rules of economics have changed. New technologies can make every investment feel like a guaranteed success. Easy credit can transform cautious investors into aggressive speculators. When these forces combine, markets can climb far beyond what underlying economic value can support. Understanding the true story of the 1920s stock market boom reminds us that financial bubbles rarely look dangerous while they are forming. At the time, they often appear logical, even inevitable. The excitement of new industries, expanding credit, and rising wealth can make risk seem invisible. But history shows that when optimism replaces caution, markets can drift away from reality. And when that gap between expectation and reality becomes too wide, it eventually closes, often suddenly and painfully. The boom of the 1920s is a powerful reminder that behind every era of spectacular financial growth lies a simple question that investors must always ask. Is this wealth built on real value, or is it built on confidence that could disappear tomorrow?